Here's the secrets of how lenders assess your risk. Look, if you've ever wondered why lenders are making decisions to approve you sometimes and decline you, you're gonna love this training because I'm gonna dive into the 5 C's. These are the 5 things that lenders truly look at to make the determination on if you should be approved or denied financing. As a matter of fact, the stronger you are in these 5 areas, the more money you'll get and the lower interest rates, the better terms. So if you wanna get more approvals, more money at better terms, then you're gonna wanna know about these 5 C's that lenders mainly use to assess your risk. We got a lot to cover, so let's dive in. So look, there's a 5C formula that all lenders use to assess your risk. And they're using this to determine, first of all, if you should just be approved or denied. If you are good in these 5 areas, then you're gonna get a lot more approvals. If you're weak in these 5 areas, you're gonna get a lot more denials. The more of these 5 that you're weak in, the more denials you're gonna get. But the good news is, if you understand these 5 and you're strong in these 5 areas, not only will you get more approvals, but you're gonna get longer terms. You're gonna get lower interest rates. You're gonna get higher approval amounts. So this really is the key to getting the most money at the best term, as well as getting way more approvals. So what are the 5? Let's dive in with number 5, which is character. So character, they're basically looking at you. They're looking at your experience in the industry. Do you have experience in running a business in this industry? This is something SBA aggressively looks at because they want to make sure they're investing in businesses where the business owner has experience and a track record in that industry. The other part of character is, how's your business credit? They're looking at the actual reputation of your business. And your business credit does control your reputation because it not only has information like how you pay your bills, but it also has a lot of other factors like your industry type. Are you high risk? Are you low risk? What public records do you have out there? Are you part of lawsuits? Amongst so many other pieces of information. So lenders, credit issuers, and a lot of other outside sources are using business credit as a way to actually judge your business's character. And by the way, consumer credit factors into this as well. They're gonna wanna also look at your personal credit to help them better assess your character as well. So character, number 5 on the list. Make sure you're working on improving your consumer credit, building your business credit, and building a track history in your industry. This is gonna help you get an A+ in the character assessment that lenders have. Number 4, it should be number 1, because it's really the most important factors look at. It's called capacity. And capacity is your ability to actually get and pay for the money that you're actually asking for. This is what lenders care the most about. How likely are you to repay them? It's why they're doing the deep assessment. It's why they're asking you all these questions. It's why they're getting all the documentation from you. It's why they're looking at your financials. It's why they're looking at your business credit reports and sometimes your consumer credit reports. They're looking at all of this information to make one determination: your likelihood that you will repay them. The more likely you are to repay them, the more money you get, the better terms you get. The less likely, the less money you get, and the worse terms you get. So if you want to get a 30-year loan term versus the 3-month loan term, then it really matters that you actually show that you have the capacity to be able to handle that financing. So to do this, you want to have good financials. You want to have a good balance sheet. You want to have bank statements that reflect that you pay your bills on time. You want to have more money going in your business than going out. You don't want to have a negative ending balance at the end of each month. These kind of things show you have the capacity to take on more debt, which makes you way more lendable. And that brings me to number 3. Capital. Capital is how much you have invested in the business. How much money is in the business? How much access to business credit do you have? How much money have you put in the business? What is your retained earnings? How much cash is actually in the bank liquid right now? What other investments do you have? What other kind of bank accounts do you have outside of just a checking account? These are the kind of things that lenders are looking at when they're actually looking at the capital that you have access to. Look, there's an old saying that you can only get money from banks when you don't really need it. Well, it's somewhat true. Banks don't want to lend to people that are desperate, out of cash, and in trouble. They don't want to lend to somebody that has all their credit cards maxed out and has no access to cash in their bank account. They want to lend to a business that's been well run, well managed, that's making more than it's actually spending, that's showing some kind of profits, that's showing revenue and profits increasing after year, that has money in the bank. Those are signs of a responsibly run business to lenders. And when they see that, it makes them way more inclined to give you approvals, to give you more money, and to give you better terms. And this brings me to number 2 on the list, collateral. Look, if you want to get the best kind of financing out there, then you need to have some kind of asset or collateral. First of all, there's a lot of money you can get just because you have that collateral. Stocks, bonds, 401ks, IRAs, inventory, cryptocurrency, vehicles, real estate, any of these things can be pledged as collateral. And if you have any of these things, you can get money just based on having that one thing, just that one asset you pledge as collateral. So for example, you can use stocks, bonds, 401ks, IRAs as leverage to get financing, get very low interest rates, get loans and credit lines, get no personal guarantee financing where credit and revenue don't even matter. That's how big of a deal collateral is. If you have it, a lot of lenders will give you money just because you have that collateral, even if it's purchase orders or account receivables. On the other side, if you want the best kind of loans that exist, loans from places like SBA, or loans like SBA loans that are guaranteed to give you long loan terms, low interest rates, and high loan amounts, they're all going to want to see you have collateral. SBA's requirements are that you have collateral equal to the amount you're borrowing. So the more collateral you have, the more money you're going to get at sources like SBA. And again, we already talked about a lot of the assets in your business, including inventory, equipment, real estate that can be used to serve as collateral. Even account receivables, which is the number one kind of collateral used to qualify for SBA loans. So have collateral. It's not required on a lot of kind of financing. You can get revenue financing and many other types with no collateral, but the more collateral you have, the better financing and the lower rates you're going to get. And that brings me to number one on the list, conditions. And market conditions have a lot to do with your ability to get financing. Look, when you see something happen like a dramatic economic shift like what we saw during COVID or the mortgage crisis, we see markets tighten up. You've probably heard this before. And what that means is it means two things. It means lenders and credit issuers are looking for more credit and access to capital, so they start lowering limits of their clients that have outstanding money that they're not using. So if you're one of those people that has a credit line for $100K and you're not actually using any of your credit line, then when the market changes, you're a target for them to lower that $100,000 to maybe $20,000 so they could free up $80,000 of lending ability to give it to other people. But the other reason that market conditions matter is because they tighten up. It becomes harder to get access to the credit financing. This means you need to have better consumer credit, better business credit, and even if you do, you're probably going to be lent less money than you would if market conditions are good. This is why you should always prepare for a rainy day. You should be building business credit. You should be securing all the credit lines you can get when market conditions are good. So when market conditions turn and go bad, you have all that money available to lean on. You're not desperately trying to go out and get money in an environment where fewer lenders are lending and everybody is trying, right? It's just supply and demand. And when the market turns, there's a massive demand for capital and lenders tighten up so there's less of a supply. So what you want to do here is get money when you can. Get money when market conditions are good and be prepared for a rainy day. Don't be one in the crowd that's running trying to get money when it's the hardest and most expensive to get. So there you go. Those are the 5 C's that lenders are looking at to assess your risk and determine if you should be approved for money. If you want access to our guide on 27 killer ways to get money for your business, you can grab it at creditsuite.com/27. And if you got value from this training, make sure you smash the like button and make sure you subscribe and keep your eye out for our next training. We're talking about more cool ways to get the money you need to start and grow your business.